The housing market isn't just broken, it's crushing the middle class harder than the 2008 crash ever did. Back then, prices collapsed. Today, they refuse to fall. And for anyone trying to buy a home, the burden is heavier than ever. If homes were cheap but out of reach in 2008, and expensive but still out of reach now, which one hurts more? And how much of today's pain traces back to Donald Trump's choices? Today, we're answering 3 questions weighing on every American family. Why are homes so expensive when the economy is supposedly stronger? How did tariffs, something most people never think about, end up making mortgages so much more expensive? And why does this affordability crash feel even worse than the collapse we lived through in 2008? In 2008, home prices fell by 20 to 30% almost everywhere. The collapse erased trillions of dollars in household wealth, and many families saw years of savings disappear in months. Entire neighborhoods in states like Nevada, Arizona, and Florida were covered in foreclosure signs. Banks froze lending and credit standards tightened overnight. Only the most financially secure could qualify for a mortgage. Bargains existed on paper, but for the average family, locked out of lending and shaken by job losses, those cheap homes might as well have been out of reach. Now in 2025, the story is very different and in many ways harsher. The national median home price sits around $422,000. That's more than double the median during the 2008 crisis, and prices are still rising in hot markets like Texas, Florida, and the Carolinas. A typical household earning the median income now spends well over 30% of take-home pay just to cover a mortgage at today's interest rates. In cities such as Los Angeles, Austin, and Miami, that share can climb past 50%. Insurance premiums in disaster-prone states have doubled or even tripled, with some Florida homeowners now paying more for insurance than property taxes. Construction costs have surged as tariffs raise material prices. Labor shortages push wages higher, and supply chains remain unstable. Unlike 2008, there aren't bargain properties waiting on the sidelines. Investors are still active. Institutional buyers scoop up homes before families can, and the market offers no relief. What was once a crisis of falling value has transformed into a crisis of permanent exclusion. The outcome is the same for ordinary families. They remain locked out of the American dream of home ownership. Only now, the barrier isn't collapsing banks, but relentlessly rising costs. During the Obama years, construction costs rose in line with normal inflation. Builders could plan budgets with some certainty, and there weren't sudden spikes from trade policy. That stability ended when Trump entered office. His first term imposed tariffs at around 20% on Canadian lumber, along with duties of 25% on steel and 10% on aluminum. These weren't minor adjustments. Lumber from Canada supplies about a third of all the wood used in American home building. Steel and aluminum are essential for everything from nails and appliances to HVAC systems and roofing. The National Association of Home Builders estimated these tariffs added nearly $9,000 to the price of a typical new home. When Biden took office, he faced pressure from industry groups to roll back tariffs, but ultimately kept them in place. In 2024, his administration even expanded them, particularly against Chinese steel, aluminum, and solar components. By then, supply chains were still shaky from the pandemic, and the combination of tariffs and global shortages meant builders paid inflated costs for every material they touched. Lumber futures and steel prices both saw sustained spikes, making housing far more expensive to produce. Now in Trump's second term, tariffs have escalated into unprecedented territory. Lumber duties are near 35%. Steel and aluminum face tariffs of 50% across hundreds of categories, covering everything from rebar to sheet metal to aluminum siding. Builders estimate this policy alone adds more than $10,000 to $11,000 to the cost of each new home before a single worker steps onto the job site. Once those higher material costs are passed along through financing, they swell into tens of thousands more for buyers over the life of a mortgage. For families already stretched thin by high rates and insurance premiums, these tariff-driven increases can be the final barrier that pushes ownership out of reach. Obama avoided this path, allowing builders to operate under predictable conditions. Biden failed to unwind the system he inherited, but it was Trump who set tariffs as a permanent fixture of American housing costs, transforming trade policy into a cornerstone of modern housing inflation. Rates tell another part of the story. Under Obama, mortgages averaged 3 to 4%, which kept payments manageable. Trump's first term pushed rates below 3% in 2020. That surge in demand drove prices higher. Under Biden, Fed hikes lifted rates to nearly 7%, doubling payments compared to only a few years earlier. Trump's return has lowered them only slightly, leaving rates stuck near 6.5%. Construction also suffers from a chronic labor shortage. Many workers left the industry after 2008 and never came back. Younger generations haven't filled the gap, leaving contractors short-staffed and forced to raise wages to attract talent. Builders report that labor alone can add tens of thousands of dollars per home compared to a decade ago. Insurance adds more weight. Premiums have soared in states hit by hurricanes, wildfires, or flooding. Some insurers have pulled out entirely, leaving families with only expensive state-backed options. Families in Florida now pay $6,000 to $10,000 a year for insurance, while many in California's wildfire zones are left with only state plans that charge far more than private insurers once did. Zoning rules also block relief. Restrictions on density, lot size, and building types prevent cheaper housing from being built. Industry groups estimate about a quarter of the price of every new home comes from these barriers. Layer all of this together and the results are clear. Even if rates fall or insurance stabilizes, Trump's tariffs keep building costs locked at record highs. In 2008, collapsing prices destroyed household wealth, but the crash also created opportunity for some. Home values fell 20 to 30%, and in hard-hit states like Nevada or Arizona, families could suddenly buy for half of what homes had been worth for just 2 years earlier. Buyers with good credit and stable jobs stepped in, scooping up foreclosed homes for under $200,000. Investors bought in bulk and held properties until the market recovered. For those positioned to act, there was a painful but real path back into ownership. In 2025, that window doesn't exist. The national median home price is around $422,000, and in major metro areas, the figures are much higher. In Los Angeles, the median's over $800,000. In Miami, it's more than $600,000. Even in supposedly affordable markets like Dallas or Nashville, prices are hundreds of thousands above what first-time buyers can reasonably manage. At today's mortgage rate of 6.5%, the monthly payment of a median-priced home runs close to $3,000 before taxes and insurance. A decade ago, with rates under 4%, that same payment would have been nearly $1,000 less. Add to that labor costs, zoning restrictions, and tariffs that inflate building materials, and the market offers no relief. The result is a housing crisis that feels worse than 2008 because it shuts families out entirely. There aren't cheap foreclosures to scoop up, no flood of discounted properties waiting for qualified buyers. Only expensive homes, punishing monthly costs, and barriers on every side. The system leaves buyers with a cruel choice: stretch finances beyond safety, or give up on owning a home altogether. That's why today's crisis, rooted in Trump's tariff policies and compounded by rising rates, labor shortages, and insurance shocks, already feels heavier and more permanent than the collapse of 2008. If Trump's tariffs keep inflating the cost of every home in America, where does this affordability crisis end?